Hello, my name is Christy Kogel from the Local Government Support Team here at SAO. Today we will be covering the common financial statement errors that we have seen GAAP basis governments make in fiscal year 2024. Our training today is split into the following sections: general errors that can affect all sections of the financial statements, MD&A, statements, notes, and RSI-specific errors. Then we will have a short reminder of additional requirements for our governments that submit for the GFOA Certificate of Excellence. Let's start with general errors. Most of the general errors we have seen this year have to do with budgetary comparisons, inconsistent terms and definitions, use of outdated terms and language, and amounts not tying between sections of the statements. As a reminder, under GASB Codification 2400.109, governments that do not prepare or report their budgets under GAAP basis will need to reconcile the budgets to GAAP. As a reminder, the budgetary comparisons are for the general fund and any special revenue funds. The three most common times we see non-GAAP budgetary reporting has to do with what GASB labels basis, timing, and perspective. Let's go into each one in a little more detail. A good example of differences of basis is when a component unit has a different basis of accounting than the reporting government. Here in Washington, that could be when you, as a GAAP basis government, have a component unit that reports as cash basis. Or if you are a calendar year-end government, but your component unit has a June 30th fiscal year end. In both cases, a reconciliation would need to be completed so that the component unit is reporting on the same basis as the primary government. For timing, we normally see this item with our governments that use biennial budgets. In this case, during the second year, your actuals would not tie to the financial statements, and there would need to be a reconciliation of the actuals to the financial statements. If you are a government that budgets on a biennial basis, but produce a budget for each year, then you can provide the appropriate budget for the year, which would remove the need to reconcile. We see a perspective difference between budgets and GAAP when governments have legal budgets for funds that no longer meet the requirements to be reported as special revenue funds, or they are considered managerial funds that roll up into a reported fund. If these funds have a separate legal budget, then the reporting fund will need to have a reconciliation to tie to the financial statements and report separate budgets to actuals. Let's look at an example. This government budgets on a biennial basis, so timing variance. This is the first year of the budget, so the actuals will match more consistently than the second year of the budget. As we will see in the next slide, they also have some funds that roll up into their general fund. To meet GAAP requirements, the bottom highlight adjustment from budgetary basis to GAAP basis is all that is needed. But this government goes the extra mile, as we will see. Before we go to the next slide, let's remember that the adjustment amount is $23,303. If we look at the bottom highlight, you will notice that there is another adjustment from budgetary basis to GAAP basis for that $23,303, which ties to the first page of the budget to actual. Everything above that line is how the government arrived at that adjustment. They even split out the basis of accounting differences, the perspective differences, and the funds that roll up into the general fund. This is more than is required by GAAP, but readers do appreciate the additional information. You may be asking what happens if readers don't know what GASB statement number 96 subscription asset proceeds means. Well, here's where this government really went the extra mile for readability. On the next page, they list the 4 possible differences between budgetary amounts and GAAP that we covered earlier, and then they explain specific differences. That GASB statement number 96, unrealized gains, that we wanted to know more about in the adjustment breakdown, are now defined, and there is an explanation for why it is not included in the budget. This is really going the extra mile for transparency. A theme you will see throughout this training is that we want to be consistent throughout our financial statement packet. This includes using terms or line item titles consistently throughout. Let's start with definitions. If you label pooled investments as a cash equivalent, then we would expect that all pooled investments are cash equivalents. If this is incorrect, you could do something like state that pooled investments are considered cash equivalents in all but the fiduciary funds. This gives a clear guidance on what is being recorded where. Now that we've covered inconsistent definitions, let's discuss inconsistent terms. As you can see on the proprietary statements, we have deposits payable, the pink highlight, and other current liabilities, the green highlight. Then on the government-wide statements, the green highlight has become unearned revenue, and the pink highlight has become other current liabilities. For outside readers, it would be difficult to understand why other current liabilities change between the statements, especially when the notes tell them transactions are accounted for in the same manner between the government-wide and proprietary statements. We want to use the same terms for balances consistently through the financial statements and notes so that we can be transparent to our readers about what is occurring at our government. As GASB has released new statements, they have changed some language which you will want to make sure has been adjusted in your financial statements. These include prior period adjustments, which is a new change. When these changes occur, we recommend that you search your financial statements, in particular the notes and MD&A, for the outdated terms. An item that both GFOA and SAO have seen for a while is items not tying between statements and notes. You can see above that the governmental activities shows $4,415,565 in unearned revenue, but the governmental funds show $4,629,893. These two items should tie since they are reported the same between full accrual and modified accrual. That's it for general errors. Moving on to the MD&A items. The most common MD&A errors that we in GFOA see are missing reasons for changes, explanations do not match expected circumstances, error corrections not reported correctly under GASB 100, restatements being used in calculating change in net position and fund balance. Let's go through some examples of each of these items. Here's the discussion included in this MD&A. This specific area discusses tax revenues. It says tax revenues are the largest source of revenue within governmental activities, making up approximately 70% of total revenues. Of this, the government noted that property tax revenue increased by 5%, are $500,000. Sales tax revenue increased by 6%, or $1 million, and utility tax generated from the sale of the city's water and sewer services increased by 9%. With the implementation of GASB 103, this discussion can be improved by adding some additional details. Let's look at an example of the MD&A improvements. We added the reasons for the changes, such as the base tax levy increased, and there was new construction, which explains the property tax increase. Growth and more employment opportunities allowed for sales tax to increase. Inflation led to an overall increase in gross taxable retail sales. Rates were increased and water consumption rose. This explains the higher utility tax. You should notice that these are specific to the government and not just general explanations. This is what we are looking for in the MD&A and what will be required under GASB 103. The narrative and tables in the MD&A should make sense with the government's circumstances and financial statements. Let's look at the example. This county is saying that in 2024, they had a $236.6 million increase to revenues. They are claiming most of this increase is from COVID money received in 2024. What seems odd about this narrative? If you said it would seem odd based on the information given that most of this increase is due to COVID, since there wasn't a large influx of money in 2024, you would be correct. If this is in relation to unearned money being classified as earned, then the narrative should explain that this was previously reported as unearned and is now being recognized. While you may know what you are trying to say, others might not, so it is imperative that your narrative is clear. An other item we see is that the narrative is describing a basis of accounting as cash when the government is reporting GAAP basis statements. This is something that has caused issues while implementing GASB 100. Since the MD&A is considered part of the required supplementary information, then the portion of GASB 100 for error corrections needs to be retrospectively applied. What does that mean for reporting? Let's walk through an example. As you can see, this government has a correction of errors and a change in accounting principle. We are only going to look at the correction of errors and assume that the errors occurred in 2023. In governmental activities, the error correction is for $247,411. This is correct reporting on the face of the financial statements. When we go to the MD&A, you'll notice that the government has a line item for change in accounting principle, but not the error correction. This may seem incorrect, but since under GASB Statement 100 in the RSI, all presented years need to be restated for error corrections, and errors are generally tied to the previous fiscal years. This is correct accounting. You'll want to make sure that the notes explain when the error occurred and what caused the error. What this means is that your error corrections reported in the MD&A probably won't tie to the error corrections reported on the face of the financial statements. Since as accountants, we don't like items that don't tie through our financial statements, a great way to explain why it is to have a footnote on your table that explains what has changed and how much the error correction was. Another issue we have seen after the implementation of GASB 100 is the reporting of the change in net position in the MD&A compared to the financial statements. In this example, the MD&A states that the change in net position increased by 14.4 million. But when we look at the statement of activities, we see the change in net position is 17.6 million. How did the city get the 14.4 million? What they did is they took the 17.6, added the 1.8 million error correction, and then subtracted out the 5 million. This is incorrect. The amount reported in the MD&A should tie to the amount reported on the statement of activities without a reader having to do any math. Moving on to the financial statements themselves. The most common error SAO and GFOA have seen is the current portion of liabilities, in particular total OPEB liabilities not being reported. Other common issues are titles that are not detailed enough to be meaningful, proprietary funds not including the disclosure of non-cash investing or financing activities, misclassifications of fund balances, and incorrect transfers between utility funds and the general fund. Let's start with the current portion of liabilities. The most common example is with the total OPEB liability, which we are showing here. Since most governments do not have a net OPEB liability, we're going to assume that the highlighted OPEB liability is a total OPEB liability. Since there is not a qualified trust for this liability, there should be a portion that is due within 1 year, both in the notes and on the financial statements. We are showing the notes here since sometimes OPEB liabilities are included in other line items on the financial statements, and this makes it easier to see the issue. Moving on to how we title our line items. While there's no standardization in titling, GFOA does require that line items are detailed enough to be meaningful. Items like miscellaneous, other operating revenue, etc. are not meaningful, and if they make up a significant portion of the revenues or expenses, they should be broken out to more meaningful line items. As a reminder, the non-cash investing, financing, and capital activities is required for proprietary funds in the cash flow statement. If you have any of these items, please remember to include them. We generally see the capital contributions not tying because the non-cash portion is not being reported. There are some misconceptions about what can be included in any fund balance classification besides unassigned. Items like budgets, emergencies, reserves, and minimum cash and investment policies generally do not meet the requirements to be reported as restricted, committed, or assigned. Moving on to transfers from utility funds to governmental funds. Let's start by looking at the statements. Generally, utility funds are restricted for the specific utility purpose, electricity, water, etc. Therefore, transfers out of the funds are unusual, and large amounts, as shown here, should be analyzed for correct reporting. Generally, these are payments for services or interfund reimbursements, which should be recorded as expenditures. Let's look at the 3 major items for these transfers. The first one is a transfer to the consolidated general fund. Based on the information provided in the note, the general fund is providing review services to the water sewer fund. This should be an expense to the water sewer and a revenue in the general fund. This transaction should be treated the same as if the general fund was performing the service for an external party. The second is a transfer to the non-major governmental funds to support the non-major governmental funds. This could be a compliance issue because the utility funds are restricted to utility purposes and general support could be incorrect. The third one concerns the Fleet Services Capital Fund. The support of vehicle activity sounds like the utility funds use the vehicles that were in the service fleet and need to pay the service fleet. This would be a standard expense in the utility funds and a revenue in the appropriate internal service fund. Moving on to the notes. The most common problems we see in the notes are referencing old GASB statements, restatements being disclosed incorrectly under GASB 100, fiduciary funds missing measurement and basis of accounting disclosures, and fund balance and net position flow assumptions. The first topic is referencing old GASB statements. We see a lot of references to GASB Statement 68 and 75, but GASBs throughout the years are still referenced. This is not a great idea because GASB amends and supersedes statements a lot, and it is hard to remember which statement amended a past statement. Since GASB statements are GAAP once implemented, we recommend just referencing the concept. For example, this disclosure states that portfolio maturity, quality, diversification, and liquidity requirements set forth in GASB Statement number 79 are met. A way to not reference a statement that was implemented a decade ago is to say something like the LGIP portfolio is managed to meet the portfolio maturity, quality, diversification, and liquidity requirements for external investment pools. As a reminder, GASB 100 requires that you not only include a narrative for changes in accounting principle, changes in reporting entity, and error corrections, like we have done in the past, but also requires you to include a table for each statement and fund that was affected. Here is a great example of a government creating a table that includes both the government-wide changes, governmental funds, and proprietary fund changes for implementation of GASB 101. As a reminder, and something GASB has seen, is that fiduciary funds need to have their economic resources measurement focus and their accrual basis of accounting disclosed. A lot of times we will see the economic resources measurement, but not the basis of accounting. Another item we are seeing in the notes is only one flow assumption being reported, either the fund balance or the net position. While most governments go from restricted to unrestricted in both flow assumptions, they do need to be disclosed separately. Moving on to the required supplementary information, also known as the RSI. The most common RSI issues we are seeing has to do with the pension and OPEB disclosures. Items such as covered payroll versus covered employee payroll and covered payroll staying the same between the schedule of proportionate share of net pension liability and the schedule of employer contributions when the measurement date and fiscal year end date are different. Let's look at a correct example of covered payroll versus covered employee payroll. On the top picture, you can see PERS 1, which is administered through a qualified trust. Because it is in the trust, we use covered payroll. On the second picture, we are dealing with a LEF 1 OPEB plan. That is not in a trust. Since there isn't a trust, then we use the covered employee payroll terminology. We recommend using the SAO RSI templates to ensure that you have the correct language or to create your own template and verify that the language is correct. Moving on to the covered payroll reported on the schedule of proportionate share. versus what is reported on the schedule of employer contributions for DRS plans. Assuming a calendar year end, we would expect the schedule of employer pension contributions would be different from the schedule of proportionate share of the net pension liability, since DRS uses a measurement date of June 30th. For those of you that prepare an annual comprehensive financial report, we have some GFOA reminders that are required for the Certificate of Excellence. Some reminders are that GFOA requires a separate spreadsheet for the net investment and capital asset calculation. All numbers must tie exactly. If any number is $1 off somewhere in the financial statement package, GFOA will comment. An increase in leased assets should have an increase in other financing sources. GFOA has a preferred method for calculating the restricted net position that is different than SAO's preferred method. GFOA prefers that the restricted net position only includes the net pension asset. For any government that is currently presenting an ACFR or is planning on producing one in the future, we would recommend using the QR code on the slide to access GFOA's checklist. This checklist is used to determine if a government will receive a Certificate of Excellence and is a great way to prepare your financial statements for this award. Thank you for taking the time today to go through the common financial statement errors that SAO and GFOA have seen in the 2024 financial statements.